In this video, I'm going to share something different, that is the financial crisis in 2008. How did the financial crisis happen and the summary of the 2008 financial crisis. Be generous to hit the like button if you like the content, or otherwise leave a comment so that I can see how to improve further. And remember to subscribe to my channel and turn on the notification bell so that you can get personal finance and money matters firsthand. So let's get into the time machine and transit back to 2008. Hi, my name is Louis, your financial educator. What really happened in 2008? You probably remember that it seems like overnight everyone was out of work and companies were laying people off. You remember having trouble making ends meet for a while and hearing tragic stories. Living through history makes it hard to understand the causes and effects. If you experienced the Great Recession of 2008, you know how it felt. Figuring out what caused it is a different story. It was a huge blow to the US and the worst economic system, one of the largest since the Great Depression of 1929. Although that crisis didn't move to global markets as quickly, there are some parallels, marked by the closing of the investment bank Lehman Brothers in September of 2008. The recession had caused that stretched well before that day. In 2008, the financial crisis shocked the global economy, and after 12 years, which I'm referring to 2020 as I'm shooting this video, people are wondering how the rules have changed, and more importantly, how this type of economic crisis can be avoided in the future. What began as a crisis in regards to the subprime mortgage market later developed into a large-scale global financial crisis and recession. From massive bailouts to the resulting economic downturn, many are now questioning the stability and transparency of the global banking systems they previously trusted. What happened during the financial crisis, referred to as the worst economic disasters since the Great Depression, the 2008 financial crisis devastated the world economy. This resulted in what's known as the Great Recession, which led to failing housing prices and sharp increases in unemployment. The associated repercussions were enormous and are still influencing financial systems today. In the US, more than 8 million citizens lost their jobs. Approximately 2.5 million businesses were devastated, and close to 4 million homes were foreclosed in less than 2 years. From food insecurity to income inequality, many have lost faith in the system. The recession officially ended in 2009, but many continue to suffer long after it. Especially in the US, the unemployment rate reached to 10% in 2009 and was only recovered to pre-crisis levels in 2016. What caused the Great Recession? The market was unstable. Everyone was able to get approved for credit even if they couldn't afford it financially. From mortgage approvals to lines of credit, everyone bought things on credit. In terms of the cost, numerous factors were to blame. The perfect storm was brewing, and once it reached its breaking point, a financial crisis ensued. Financial institutions were giving out high-risk loans, mainly mortgages, that eventually resulted in a massive taxpayer-financed bailout. That means the real money flows dried up. As more people bought on credit instead of actual funds, inflation grew and people started making conjectures about oil prices. There was also higher unemployment, which drives up inflation too. The true cause of 2008 financial crisis is highly complex, but it was America's housing market that initiated a chain reaction, one that would expose cracks in the financial system. This was followed by the bankruptcy of the Lehman Brothers firm, which had a crippling effect on the American and European economy. In turn, the episode made the public aware of banks' potential shortcomings. It also caused significant disruptions around the world, based on how the global economy is interconnected. When financial institutions give credit, it's based on capital, usually your home. Yet homes begin to lose value. If your home isn't worth as much, or you are foreclosed and no longer have your home, the creditors have no way to collect the money you owe. Why does it matter today? Similar recessions in the 80s, property prices crashed, and 90s worldwide currency crisis showed the world what a recession of these proportions could look like, yet it still came as shock to many when it finally hit in 2008, affecting the world much faster than the Great Depression did. The recession of 2008 shaped generations and how they respond to emergencies and financial problems, especially millennials. One of the reasons they cite is a huge drop in the cost of homes. That means everyone's real estate investments, even if it's only one house, the one you live in, was worth significantly less instead of appreciating as it should. Corporate losses also hit us hard as companies struggled to recover and employees felt the effects. If you experienced setbacks in your career back then, you may still be seeing the results. Your salary might not yet have grown back to where it would have been without the Great Recession. Over a lifetime, some estimates say it will cost about $70,000 for every American. Although it has been a decade since the financial crisis hit, there are still concerns. The effects of this recession are still alive, and the global economic recovery has been fairly weak in comparison to historical standards. High-risk loans are being offered once again, and although default rates are low today, that could change very quickly. Regulators insist that the global financial system has been altered since 2008 and that safety measures have been considerably enhanced. For this reason, many believe that the global financial system is stronger today than it was a decade ago. On the other hand, some are still wondering, could this type of economic crisis happen again? The short answer is yes, anything is possible. Despite the many changes that were made and the new rules that were enforced, there are fundamental problems that remain. Noteworthy, the 2008 financial crisis reminds us that policy matters. The events that took place in 2008 were essentially caused by the decisions that regulators, politicians, and policymakers made years prior. From poorly controlled regulatory bodies to the impact of corporate culture, the Great Recession is anything but in the past. While the rise of a financial crisis in 2008 highlighted some of the risks associated with the traditional banking system, 2008 was also the birth year of Bitcoin, the first cryptocurrency to be created. In contrast to fiat currencies such as the US dollar or British pound, Bitcoin and other cryptocurrencies are decentralized, which means they are not controlled by a national government or central bank. Instead, the creation of new coins is determined by a predefined set of rules, protocol. The Bitcoin protocol and its underlying proof of work consensus algorithm ensure that the issuance of new cryptocurrency units follow a regular schedule. More specifically, the generation of new coins is reliant on a process known as mining. The miners are not only responsible for introducing new coins into the system, but also for securing the network by verifying and validating transactions. In addition, the protocol establishes a fixed max supply that guarantees there will only ever be a total of 21 million bitcoins in the world. This means that there are no surprises when it comes to the current and future supply of Bitcoin. Moreover, the Bitcoin source code is open source, so anyone is able to not only check it but also to contribute and participate in its development. Although it has been a decade since the 2008 financial crisis, many have not forgotten how fragile the international banking system really is. Yet you can move forward with your financial decisions to help combat the long-lasting effects of the recession. Thanks for watching. See you in the next video.